Welcome to our channel, where we dissect trading techniques, strategies, and theories to make you a more skillful and proficient trader. In today's video, we are going to explore one of the essential tools in technical analysis, chart patterns. Chart patterns, as graphical illustrations of an asset's price fluctuations, often signal whether the current trend will continue or reverse. Developing the skill to recognize and analyze these patterns is crucial in predicting future price trends. This understanding can help you to make well-informed and strategic decisions in trading. Chart patterns can be broadly classified into three types: reversal, continuation, and neutral. Let's start by introducing each category. Reversal patterns signal that the current trend may be about to change. These include double tops, double bottoms, triple tops, triple bottoms, head and shoulders, inverted head and shoulders, falling wedge in a downtrend, and the rising wedge in an uptrend. Continuation patterns indicate that the market will continue its previous trend after a brief pause. Examples of these are bullish flags, bullish pennants, bearish pennants, falling wedge in an uptrend, and the rising wedge in a downtrend. Neutral patterns, including ascending, descending, symmetrical, and symmetrical expanding triangles, signal that investors are unsure about the next market direction. These patterns often precede significant price breakouts. Let's explore each pattern in detail, understand the market psychology behind it, learn how to identify it, and interpret the potential market behavior. Now, let's get started with the reversal patterns first. Double tops and double bottoms. The double top pattern is a bearish reversal pattern, typically forming after an uptrend. It's characterized by two consecutive peaks that are roughly at the same price level, signifying strong resistance. The area of price reversal between the two tops is known as the valley. The line drawn from this valley to the line connecting the two peaks forms the neckline. The market psychology behind this pattern reflects a struggle for control between buyers and sellers. The first peak represents the maximum level of buyers' confidence. As the price retraces to form the valley, it is expected that buyers will push the price up to new highs. But the second peak level shows that sellers have taken control, and a bearish reversal is imminent. The pattern is confirmed when the price falls below the neckline following the formation of the second top. This is often considered a signal to sell, as it is expected that the price will continue to drop. In contrast, the double bottom pattern is a bullish reversal pattern, often forming after a downtrend. It is represented by two consecutive troughs that are approximately at the same price level, signifying strong support. The price recovery area between the two bottoms is the peak. The neckline in this case is the line connecting the peak to the line through the two bottoms. The market psychology behind this pattern is the mirror image of the double top pattern. The first bottom represents the maximum level of sellers' confidence. As the price retraces upwards to form the peak, it is expected that sellers will push the price down to new lows. But the second bottom level shows that buyers have taken control, and a bullish reversal is imminent. The pattern is confirmed when the price rises above the neckline following the formation of the second bottom. This is often considered a signal to buy, as it is anticipated that the price will continue to rise. Head and shoulders and inverted head and shoulders. The head and shoulders pattern is typically seen as a signal of a bearish reversal after an uptrend. It consists of three peaks: the left shoulder, the head, and the right shoulder, with the head being the highest peak, flanked by the lower shoulders. The formation of this pattern suggests that the market is losing momentum. Initially, the uptrend reaches a high, forming the left shoulder, and then pulls back. The next rally exceeds this high, forming the head, but fails to maintain momentum, leading to another pullback. The final peak, attempting to surpass the head and create a higher high, eventually falls short, forming the right shoulder. This signals a decline in buying interest and suggests a shift from buyer to seller dominance. The neckline, drawn by connecting the lowest points of the two troughs, is crucial. A decisive break below this neckline confirms the pattern and indicates a shift to a downtrend. This is often considered a signal to sell, as it is anticipated that the price will continue to drop. On the flip side, the inverted head and shoulders pattern, as the name suggests, is the head and shoulders pattern flipped upside down. The inverted head and shoulders pattern is typically recognized as a signal of a bullish reversal following a downtrend. It is composed of three troughs: the left shoulder, the head, and the right shoulder, with the head forming the lowest point and the shoulders being higher. This pattern indicates a potential shift in market momentum. Initially, in a downtrend, the price reaches a low, forming the left shoulder, and then rallies. The subsequent decline goes below this low, forming the head, but fails to sustain this downward momentum, leading to another rally. The final trough, attempting to go lower than the head and create a new low, does not succeed, forming the right shoulder. This indicates an increase in buying interest and suggests a potential shift from seller to buyer dominance. The neckline, drawn by connecting the highest points of the two rallies, is a key level. A decisive break above this neckline confirms the pattern and signals a shift to an uptrend. This is often considered a signal to buy, as it is anticipated that the price will continue to rise. Triple top pattern and triple bottom pattern. The triple top pattern is a bearish reversal signal that typically forms after a strong uptrend. It consists of 3 peaks at approximately the same price level. The formation of this pattern reflects a scenario where the price attempts to break through a resistance level 3 times but fails each time, indicating a strong resistance area above. The first peak is formed during the continuation of an uptrend, when the price pulls back and then rises to form a second peak but fails to break through. It suggests that buying momentum is waning. The market psychology for the triple top pattern is actually an extension of the double top pattern. After the formation of the first 2 peaks, the third peak that also fails to surpass the resistance level confirms the buyer's exhaustion. This repeated failure to break through the resistance level reflects growing pessimism and waning buying interest among traders. When the price falls and closes significantly below the support level, the low points between the peaks, known as the neckline, the pattern is confirmed. This decisive break below the support level signals that sellers have gained control and indicates a potential shift to a downtrend. This is often considered a signal to sell, as it is anticipated that the price will continue to drop. Conversely, the triple bottom pattern is a bullish reversal signal that usually develops after a strong downtrend. It consists of 3 troughs at approximately the same price level. This pattern forms when the price fails to break through a support level 3 times, suggesting a strong support area below. Echoing the triple top, the market psychology of the triple bottom pattern reflects a reverse scenario. The first trough is formed during the continuation of a downtrend. When the price rebounds and then declines to form a second trough without breaking below the support, it suggests that selling pressure is decreasing. The creation of a third trough that also fails to breach the support level indicates sellers' fatigue. The repeated failed attempts to push the price below the support level shows a diminishing bearish sentiment and increasing optimism among buyers. A decisive break and close above the resistance level, the high points between the troughs, known as the neckline, confirms the pattern. This break indicates that buyers have taken control, suggesting a shift to an uptrend. This is often considered a signal to buy, as it is anticipated that the price will continue to rise. Falling wedge in a downtrend and the rising wedge in an uptrend. First, the falling wedge, or bullish wedge, in a downtrend. This pattern typically forms during a downward trend when the market experiences a brief consolidation period. During this period, lower highs and lower lows are made within a narrowing price range or wedge. The falling wedge pattern is confirmed when there is a decisive breakout above the upper boundary of the wedge. Even though the overall trend is downward, this pattern is a bullish reversal pattern. The market psychology behind this pattern is that, after a significant price drop, the market begins to decelerate in its descent. Although sellers try to push the price down, the diminishing strength of the downtrend and the narrowing of the price range suggest a dwindling selling pressure. When buyers regain control and push the price up, breaking out of the wedge to the upside, a reversal of the prevailing downtrend is signaled. This is often considered a signal to buy, as it is anticipated that the price will continue to rise. Next, the rising wedge, or bearish wedge, in an uptrend. This pattern typically forms during an upward trend when the market experiences a brief consolidation period, characterized by higher highs and higher lows within a narrowing price range or wedge. The rising wedge pattern is confirmed when there is a decisive breakout below the lower boundary of the wedge. Even though the overall trend is upward, this pattern signals a bearish reversal. The market psychology behind the rising wedge in an uptrend is that after a significant price rally, the market begins to lose momentum. Buyers try to push the price up, creating the rising wedge, but the reducing rate of ascent and narrowing price range suggest a weakening buying pressure. As sellers regain control and push the price down, breaking out of the wedge to the downside, a reversal of the prevailing uptrend is signaled. This is often considered a signal to sell, as it is anticipated that the price will continue to drop. Now let's move on to the continuation patterns, bullish flags and bearish flags. The bullish flag pattern typically forms after a strong upward price movement known as the flagpole. Following this surge, the price enters a consolidation phase and tends to drift downwards within a channel or a rectangular shape, forming the flag. Despite the brief downtrend during the flag formation, This pattern signals a continuation of the prior uptrend. The pattern is confirmed when there is a breakout above the upper boundary of the flag. The bullish flag pattern forms after a rapid upward movement, reflecting strong investor optimism. The subsequent consolidation phase, or flag, represents a temporary pause as some investors take profits and new buyers hesitate, causing a slight pullback. However, this pause typically occurs on low volume, indicating that the bullish sentiment is still strong. When the price breaks above the flag, it signals renewed buying interest, suggesting the uptrend's continuation. This is often considered a signal to buy, as it is anticipated that the price will continue to rise. The bearish flag pattern, the inverse of the bullish flag, forms after a strong downward price movement or the flagpole, followed by a consolidation period that tends to drift upwards within a channel or a rectangle, forming the flag. Despite the brief uptrend during the flag formation, this pattern signals a continuation of the previous downtrend. The pattern is confirmed when there is a breakout below the lower boundary of the flag. The bearish flag pattern follows a sharp downward movement, reflecting widespread negative sentiment. The subsequent consolidation phase, an upward correction within a downtrend, is a period of temporary pause. It's typically characterized by low volume, signifying that the bearish outlook remains dominant. The downward breakout from this flag indicates that sellers have regained control and are set to continue the downward trend. This is often considered a signal to sell, as it is anticipated that the price will continue to drop. Bullish pennants and bearish pennants. The bullish pennant pattern typically forms after a strong upward price movement, known as the flagpole. Following this surge, the price enters a consolidation phase, making successive higher lows and lower highs, and forming a small symmetrical triangle, or the pennant. Despite the brief period of consolidation during the pennant formation, this pattern signals a continuation of the previous uptrend. The bullish pennant pattern is confirmed when the price breaks out above the upper boundary of the pennant. The market psychology behind the bullish pennant can be understood as a pause in the market after a strong price rise. During this pause, buyers and sellers are roughly balanced, causing the price to move in a tight range with a slight downward bias. However, this pause is usually temporary, and when the buyers regain control, the price breaks out of the pennant, confirming the pattern and continuing in the direction of the prior uptrend. This is often considered a signal to buy, as it is anticipated that the price will continue to rise. Conversely, the bearish pennant pattern forms after a strong downward price movement, or the flagpole. This is followed by a period of consolidation that makes successive lower highs and higher lows, forming a small symmetrical triangle, or the pennant. Despite the brief period of consolidation during the pennant formation, this pattern signals a continuation of the previous downtrend. The bearish pennant pattern is confirmed when the price breaks out below the lower boundary of the pennant. The market psychology behind the bearish pennant is the mirror image of the bullish pennant. After a strong price decline, the market takes a pause, during which buyers and sellers are roughly balanced, causing the price to move in a tight range with a slight upward bias. However, this consolidation is usually temporary, and when sellers regain control, the price breaks out of the pennant, confirming the pattern and continuing in the direction of the prior downtrend. This is often considered a signal to sell, as it is anticipated that the price will continue to drop. Falling wedge in an uptrend and the rising wedge in a downtrend. First, the falling wedge, or bullish wedge, in an uptrend. This pattern typically forms when the market experiences a brief consolidation period, characterized by lower highs and lower lows within a narrowing price range, or wedge, in the midst of an overall upward trend. Despite the temporary downward bias during the formation of the wedge, this pattern is a bullish continuation pattern. The falling wedge pattern is confirmed when there is a breakout above the upper boundary of the wedge. The market psychology behind this pattern is that after a significant price rally, the market begins to take a breather. Sellers try to push the price down, resulting in the formation of the falling wedge. However, this is usually a temporary phase, and as the selling pressure begins to wane, the buyers regain control and push the price up again, breaking out of the wedge to the upside and continuing the prevailing uptrend. This is often considered a signal to buy, as it is anticipated that the price will continue to rise. Next, the rising wedge, or bearish wedge, in a downtrend. This pattern typically forms during a brief consolidation period in a prevailing downtrend, characterized by higher highs and higher lows within a narrowing price range, or wedge. Despite the temporary upward bias during the formation of the wedge, this pattern signals a continuation of the bearish trend. The rising wedge pattern is confirmed when the price breaks out below the lower boundary of the wedge. The market psychology behind the rising wedge in a downtrend is that after a significant price decline, the market begins to pause. Buyers try to push the price up, creating the rising wedge. However, this consolidation is usually short-lived, and as the buying pressure begins to diminish, sellers regain control and push the price down again, breaking out of the wedge to the downside and continuing the prevailing downtrend. This is often considered a signal to sell, as it is anticipated that the price will continue to drop. Now, let's move on to neutral patterns. Triangle patterns represent a period of consolidation before the price breaks out. They are typically classified as neutral or non-directional patterns, meaning they can break either upwards or downwards, and thus don't necessarily suggest a particular direction. They are characterized by trend lines that converge, indicating a narrowing price range as the pattern develops. This is true for ascending, descending, and symmetrical triangles. However, there is an exception in the case of symmetrical expanding triangles, where instead of converging, the trend lines diverge, suggesting a widening price range. Regardless of the type, the confirmation of all triangle patterns comes with a breakout, where the price moves decisively in one direction or another, breaking through one of the trend lines. First, the ascending triangle features a horizontal upper trend line and an ascending lower trend line. This pattern forms during a phase where the price is unable to breach a consistent resistance level, the horizontal line, but the lows are increasingly higher, showing a compression of price. The market psychology here reflects a balanced battle between buyers and sellers keeping the price from breaking the resistance, and buyers gradually lifting the lows. The breakout, either above the resistance or below the ascending line, ultimately determines the direction of the price movement. Second, in a descending triangle, there's a horizontal lower trend line and a descending upper trend line. It develops when the price consistently finds support at the same level, but the highs are progressively lower, indicating a tightening of price range. The market sentiment in this pattern is one of equilibrium, with buyers preventing a price drop below the support level and sellers pushing down the highs. The direction of the trend following this pattern is decided by a breakout, which can occur either below the support or above the descending line. Next, the symmetrical triangle is characterized by converging upper and lower trend lines, where both the highs and lows are converging towards a single point. This pattern suggests a period of consolidation, with neither buyers nor sellers gaining a clear advantage, leading to decreasing price volatility. The breakout from this pattern, upwards or downwards, will indicate which side has eventually dominated, setting the future course of the price trend. Finally, the symmetrical expanding triangle is formed by diverging trend lines, where the highs get higher and the lows get lower. This pattern represents a market in increasing disagreement and uncertainty. Unlike other triangle patterns, the expanding nature shows an increase in volatility and indecision. The final direction of the trend is unclear until a significant breakout occurs, which will reveal whether buyers or sellers have taken control. In all cases, these patterns reflect a tug-of-war between buyers and sellers, with the breakout indicating which side has gained the upper hand. Traders should wait for the breakout to confirm the direction of the trend and make their trading decisions accordingly. Understanding chart patterns can greatly enhance your trading strategy. They are a powerful tool in technical analysis, providing valuable insight into market psychology and potential price movement. However, it's essential to remember they're not foolproof. They should always be used in conjunction with other indicators and studies, such as volume, candlestick patterns, and support and resistance levels across various time frames, to reinforce and solidify the signals. Take, for example, the head and shoulders pattern, where volume plays an integral role. Ideally, it should decrease as the right shoulder takes shape and surge dramatically when the price breaks below the neckline. One key point to remember is not to rely on patterns until they are fully formed. A pattern is confirmed only when there is a clear breakout from its formation. Before this breakout, the pattern remains provisional and could evolve into a different formation. Thank you for watching this video. Feel free to drop any questions in our Telegram group, and we will do our best to provide answers. Engaging with fellow traders can also provide valuable insights and different perspectives. As always, trade smart, and we'll see you in the next video.